But silver's breaking out. It looks like 44 is kind of that next upside target. And I got a feeling like when you look at the monthly chart of silver, we're in a sweet scenario right now with silver where I think we could go all the way up and we could see it spike. I think we could get up to that $49, $50 an ounce in silver. I think it could have a blow off phase and shoot higher.
14 years ago right now, like this month or whatever, you were at a time where we thought surely it's going to go over 50. I think everybody sort of knows that when it breaks over 50, it's going to lurch higher, and it's going to come back, and test 50 and then probably go to 100. But the thing is that you're like, who really cares? I mean, 41 to 100, like what is really the big deal?
Chris Vermeulen, a seasoned market strategist, explained that gold's recent pullback is less a sign of weakness and more a pause after a strong surge. He noted that capital flows appear to be rotating between miners, silver, and gold, with silver currently showing the most speculative upside. According to him, silver could push toward $44 in the near term and even stage a blow-off rally to $49 to $50 an ounce, a move reminiscent of its parabolic spike before the last financial crisis, which was followed by a steep 60% collapse. Vermeulen emphasized the importance of timing rotations between assets. He suggested that while gold may continue to climb another 10 to 20% as equities soften, he would look to reduce exposure when the stock market breaks down more severely. Historically, gold tends to hold value better than stocks during sell-offs, but it isn't immune to sharp pullbacks when margin calls force investors to liquidate even their strongest holdings. This interplay, he explained, highlights why traders must remain nimble as sentiment shifts. Stepping back, Vermeulen pointed to the long-term picture, where gold's monthly chart shows a powerful multi-year uptrend, placing it among the best-performing assets over time. He drew a parallel to 2007, when gold displayed similar strength just before a major financial reset. Turning to equities, he observed that the S&P 500, through the SPY ETF, has sharply rebounded from its 20% decline earlier in the year and now sits near record highs. For Vermeulen, these patterns suggest that while short-term volatility is inevitable, gold remains central to navigating the next market cycle. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
No, so if we look at gold, all it's done is, we can look at the 30-minute chart over the past week and a half. Gold has had this a very strong move. And after something's had a strong move, it's just taking a pause. I wouldn't say it's weakening. It's just taking a breather because it just had a hell of a run. It's exhausted. Right. There's just some profit taking. And so even when we look at the daily chart, which is very similar, we're just trading sideways. And it's a little tiny bull flag. It's primed and ready to shoot up literally, the next trading session, this thing could pop and run. And so I think right now in the precious metal space, money is actually chasing the gold miners and the silver miners. Gold's taking a pause. Money's rotating out of gold because it just had a nice move. And we're seeing it move into like silver miners and gold miners. You can see they're extending and pushing higher. And we were long SILJ. We just hit a 20% target yesterday. We've actually closed that position out. I think now we might see, miners take a bit of a breather and a pause. And as money rotates out of miners with some profit taking, we flip back to gold, and gold has got this little pause that it's just had, and now gold will probably shoot up. So I think they're going to like piggyback on each other. That flows into miners and then flows into gold and goes back and forth. That's what I think is going to unfold here. We actually own both. We were in silver miners. We've closed them out because we've hit our max target that satisfies that strategy. We're still long gold. We actually own both of them because you don't know which one's going to outperform, and they're both kind of the same play. So you can take advantage of both, split your capital, or you can pick one if you want. But miners and gold, you never know which one's going to take off. So I like kind of both. And gold to me has the highest win rate. When there's a trade set up, it wins most of the time. So I like to have a sure bet in there almost. And then the miners are the more speculative play. Understood.
What about silver?
Yeah, if we take a look at silver, we haven't traded silver just because gold, our play around silver was the silver miners. And so silver has done the very similar to gold as it's rallied up, and now silver's had a nice bull flag. It's paused. And so silver's breaking out and starting to run. So money's coming, I think, out of miners now and starting to go into silver. And then I think it'll bleed over into gold, because silver is much more speculative than gold. So money's going to rotate probably from miners, silver, gold, and then kind of maybe loop around. I mean, these are very nuanced, small moves, but silver's breaking out. It looks like 44 is kind of that next upside target. And I got a feeling like when you look at the monthly chart of silver, we're in a sweet scenario right now with silver, where I think we could go all the way up and we could see it spike. And I think we could get up to that $49, $50 an ounce in silver. I think it could have a blow off phase and shoot higher. Very similar to, what happens near the end of a move is you get a very strong parabolic move. You cannot trust a move that goes straight up, because usually it comes straight back down. Very similar to what happened just before the last financial crisis. It shot straight up, came straight back down, and then sold off for 65%. So I think we have that potential for it to shoot higher still. And of course, that'll be good for silver miners as well. The problem is we're coming to a turning point. And when things turn, I don't want to hold anything. So I still like gold the most, physical gold or through an ETF. I think that has got good upside potential here. I think it still has 10 to 20+% upside. I also think, because I have to hold it for a year, I think bonds like TLT would be a good position as well. So the bonds could come to life and really start a nice move up. And eventually it'd be nice to sell gold. And because when the stock market does roll over, eventually gold will most likely pull back with it. But gold holds its value fairly well. It doesn't drop as much as the stock market. So I would say like gold and bonds would be those plays. If you had a gun to my head and said you have to buy and hold, it's probably the two that I would do. Typically we see gold, like we could see the stock market top out and potentially fall 10, 15% from here. And gold keeps going up another 10 or 20%. But eventually when the stock market falls a certain amount and people start to get really scared, there's real fear, we actually enter a bear market, then gold usually doesn't stand a chance. There's enough selling and margin calls and fear that even people sell off the good positions like gold. And so gold naturally will sell off temporarily, but it's usually short-lived. Gold only gets pulled down during an extreme wave of selling. It could last a few months in the markets, and then it'll find a bottom way before the stock market does. So yeah, gold is not immune to a bear market, but it can rally. In this particular situation, 2007, which is a very similar situation as we have right now, when you look at from price charts and what the dollar is doing and what gold's doing in the stock market, the equities market could sell off and top at any point here, and gold just keeps on going another 20+%. So that's why I like gold at this point. Yeah, there's a few key currents. I think looking at the big picture might be important. I think the stock market is getting pretty frothy. If we look at the charts, we'll actually take a look at the big picture and actually go to gold first. So gold, in a nutshell, I'm just going to flip to the monthly chart. Gold has been on a tear, like, for a couple of years. It's outperforming. It's becoming one of the best performing assets long-term. Last time we saw this was like in 2007, just before a major stock market and financial reset in the economy. Gold is kind of a barometer, a global barometer, like planet Earth and the people on it's like a beehive mentality. The whole world is nervous that something is about to happen. And they tend to move to gold. They move away from equities to some regard. They move away from currencies. They move away from even real estate, and they start to move to gold. They want something physical, something outside of the financial system. And gold is telling us that people are preparing for something bad to happen. We don't know what it is. We don't know, when the shoe is going to fall and trends are going to change. The economy situation is going to change, but gold has just been on this tear, and it's outperforming and it's extending to the upside. That is an early warning sign to be careful for the stock market. But if we zoom in now and go to the overall stock market, I'll go to like the SPY, which is the S&P 500 ETF. We've obviously had a very nice rally coming out of the lows from this year. We had the big 20+% sell-off. Now the markets are pushing near hitting all-time highs, and really people are buying into this market up here.
E.B. Tucker, a longtime precious metals investor, admitted that he has never been much of a silver enthusiast, even after years of following the market closely. While silver's price has returned to levels last seen in 2011, he questioned the excitement, arguing that even if it breaks above $50 and eventually climbs to $100 an ounce, the payoff isn't especially compelling compared to speculative tech stocks that can rise tenfold. Still, Tucker acknowledged that the system of financial control over prices is beginning to weaken, creating an environment where silver's price may move more freely than in the past. Turning to gold, Tucker highlighted its powerful rally to $3,600, suggesting that much of the advance was a prelude to major disruptions in the financial system. He noted that gold often rallies before crises fully unfold, as it did in 2008 when it spiked to $1,000 months ahead of the financial meltdown. While projections of $4,000 per ounce capture attention, Tucker cautioned against chasing specific price targets. Instead, he emphasized that the real key is simply owning gold, rather than fixating on the exact number. Let's get back to the interview.
But here's the thing. I know this is going to sound weird, but I actually don't like silver. I mean, it like I spent a lot of time this weekend. I've been hunting around for the silver, right? I haven't even found all of it yet. You can't even store this stuff. It's too much. Like, you forget where you put it. I've sold houses and I'm convinced there's like, 1,000-ounce bar left, like in the basement and stuff. I mean, it's like you can't even store all this stuff. Now, what I don't understand is that the price really is almost back to where it was, in like the summer of 2011, pretty much, right? So like, 14 years ago, right now, like this month or whatever, you were at a time where we thought surely it's going to go over 50. I think everybody sort of knows that when it breaks over 50, it's going to lurch higher, and it's going to come back, and test 50 and then probably go to 100. But the thing is that you're like, who really cares? I mean, 41 to 100, like, what is really the big deal? I mean, you have, like, we were talking about flying taxi stocks in the newsletter, just for fun, by the way. It's not like, something we're really working on, but
Yeah.
these things go like 10x or whatever. And you're like, but you get these silver people who are like totally bananas over silver. And it's only going to, like, what are you going to get a double off that? And then you can't even, I mean, I'll have like 300 or 400 pounds of silver. It's like, you can't even put this stuff anywhere. But anyway, it's worth having some, right? Because I've been in that market for a long time. And I'm telling you that basically commodity finance is what kept that market down. And so that's breaking down right now. Like, that's
Mhm.
what's
No.
breaking down, is the ability to move prices around. There's not many. Yeah, I mean, it's like you can own them all. You can have, like, on your fingers, you can have all of them. It's like there's not that many, and they're tiny, and they're run by the same people. And so I think
What?
you play this, you play it because it's here, but like, you don't get carried away. I mean, I was telling my kids that about, like, when I got interested in silver and gold, and what I did, so people can understand this, because I think people, they just think that, like, I'm rich or something from like birth or whatever. But I mean, I was like buying a little bit of. I'm looking at the dates of all this stuff that I was buying. I just would go and buy like one gold coin for, $650 or something in a month or whatever. This is like 20 plus years ago. I mean, there wasn't any like, I'm going to get rich or something like that. I was just like, I sort of have been struggling. I don't want to struggle again. Right. So, like, I think people have to, like, really analyze their thinking. I mean, they say they're going to buy like 10 ounces of silver and they're going to, like, retire or something. I mean, it's like,
But
probably
I
not. I think, unfortunately, we've sort of like made this run temporarily. This is probably a pretty good run. Like, I mean, I think there's a little bit of like a readjustment of some things going on. So now you get up here like, 3,600, and you're like, okay, so you could have a 10% move is $4,000. It sounds like a big number, but when you start thinking about it, you're like, we've had a lot of move now, and the move normally is in advance of the thing, right? Remember, like, in the past that, like in 2008, gold hit 1,000 in March, but then it came down, and then we had the crisis, right? So, like, it's like it moved before the crisis. I mean, it tends to move in advance of things changing. And so probably what's going to happen is a bunch of change at the Fed, a bunch of change in policy, a bunch of change in kind of how things flow. And then we'll look back and we'll say, oh, that's why gold was in advance moving up to, $3,600. And if you don't have any, right? Like, what's the thing to do if you don't have any? I mean, when's the best time to plant an oak tree? Like, either today or, yesterday. I mean, it's not like wait for it, right? So, like, if you don't have any, you got to have like a percentage. That's the way to look at it, right? Like if you have like a small percentage gold, that takes all the guessing out of the price stuff. I mean, like Bitcoin, is probably going to go higher. That's the thing that you're seeing is that the price of gold right now, there's like $25 trillion of the gold in the world, and there's like 2.4 or $5 trillion worth of Bitcoin. And I don't think you need to get crazy with the math. Just be like, look, I mean, there's a lot of money in this. There's like too much money floating around all over the place in the world. And like Bitcoin's probably going to go up. Gold's already gone up. Like it's some of this stuff is pretty easy. Yeah. Okay. So everybody wants this, but it's not usually the way that it works. I mean, typically things evolve into the next system. I mean, it's like you had, German money collapse evolves into the next. Everything is kind of like evolving into the next thing. And what you want to do is you want to like flow along with it. I mean, it's like people get like, we got to defend this. I'm like, what do you mean we got to defend this? I mean, look, you came into the world around, 1970, let's say. And, it's pretty obvious what's happened since then. Every 8 years, the size of the federal debt has doubled. So if you had 8-year presidents all the way up, basically every 8-year president since 70, the debt's doubled. So when it was, 1 trillion, when Reagan saw 1 trillion, people were like, we're doomed. But then it went to 2 trillion, and then it went to 4, and then it went to 8, and now it's 36 or something. It's going to go to 70. I mean, and everybody's like, no, it can't happen. We're going to go back to like trading, shovels for bread or something. I mean, forget about it. Like maybe, but I think it's more likely that they have figured out that the trick is to make people feel distracted by making them feel rich. And that's what happens. That's the Powerball effect. What happens is that if I can make you feel like there's hope that you're going to have some big money event in the future somewhere or something. I listen to people in New York on the subway talking about this Powerball. It's so dumb. They all like, what if I win this thing or whatever? Okay, great. I mean, you'll be dead because everybody that wins the lottery ends up like incarcerated or like with a bunch of face tattoos or like having some huge problem, right? You ever read these stories? It's crazy.
Yes.
So you do not want to win the Powerball. It's like the worst thing that could ever happen to you. Meanwhile, this person on the subway could have just bought like $20 worth of a gold ETF for 20 years, right? Because, and had like done pretty well, right? But that's not good enough. That's not good enough. I need a collapse prediction of the entire world. There's going to be an EMP attack, and that's what people want to know about. And it's like, I don't know. I don't really think this way because I think there's probably going to be people profiting and surviving, for the next 40 years doing something. And I want to be one of them. That's like my mindset.
Gold's sustained strength and silver's more speculative rallies highlight how investors are gravitating toward hard assets as signals of stress build across global markets. Gold often rises in advance of economic shifts, holding value even when equities turn volatile, while silver can deliver sharp upside but with far greater swings. Though both can be dragged down temporarily in periods of extreme selling, history shows gold tends to stabilize much earlier than the stock market, and silver often rebounds strongly in its wake. Keeping a measured allocation to gold and silver removes the pressure of perfect timing and ensures a safeguard when financial conditions change. What's the best way to balance gold and silver in a portfolio? Stay tuned. If you're interested in real, data-backed insights on the financial system, be sure to like and subscribe so you never miss our weekly updates. Thank you for your support, and we hope you enjoy the video.